All righty. We got a good number of participants in here, around like over 50. So we're going to go ahead and get started here tonight. What I wanted to talk about tonight is something I talked about a couple months ago, but I've seen a lot of people asking me on social media about the market volatility right now, the craziness going on in the market, and I wanted to revisit this phrase that I really love, especially when we're experiencing short-term volatility in the market. And that would be when in doubt, zoom it out. And what I mean by that is if you're ever doubting the market or your holdings, when in doubt, zoom it out. And I'll show you what that means here in a second. But that's kind of what I wanted to cover tonight on this training. And then, we'll have some time at the end here for question and answer. But with that being said, my name is Colin, but you probably know me better as DecadeInvestor. That's where I am, all over social media. So that's what I'm going to talk about today is when in doubt, zoom it out. So the biggest thing of information I can give you is historically speaking. So we can never predict the market. We can never assume anything to be true in the future of the market. But historically speaking, the stock market has never failed to recover from a crash. So you go all the way back to 1929, the Great Depression, the stock market recovered. 1987, the stock market recovered. 2001, the stock market recovered. 2008, the stock market recovered. And if we just go back 1 year ago in 2020, at least right now the market has recovered, right? So in the history of the stock market, it goes up and to the right. And what I mean by that is if you look at this graph on the bottom right of the screen, up and to the right, meaning as you move right across the bottom axis, it goes up, right, over the long term. You can see there's some certain dips that come around. You can see the 2001 dip, the 2008 dip, and then the brief 2020 dip. But if you zoom it out to, I believe this goes back to the 1980s, this graph, it's over the long term, it goes up and to the right. So like I said, the market always in the short term is volatile, but it's been very volatile recently. And I just want to come on to say and teach that don't doubt your long-term holds, right? I know that a lot of the people, or quite a bit of the people in the Wealth Squad, do a lot of trading. That's great. I personally don't do any trading, but I believe that everyone should have a long-term portfolio, that they, take some of their winnings, some of their profits from their trading and make that quick money turn into forever money. So with that being said, where's that volatility in the market? You never want to doubt your long-term holds. And I'm not saying that every single stock is going to go up and to the right, but if personally, I like putting my money in broad market index funds, ETFs like VTSAX that, owns the entire US market. Essentially you're saying, I believe that as the economy of the country, United States, moves in the future, we will go up and to the right. So that doesn't mean that every single stock within that is going to go up and to the right, but it does mean if you believe in the economy as a whole, essentially, if the U.S. economy goes down to zero, we have bigger things to worry about than what our portfolio is sitting at. If the S&P 500 goes to zero, there's other issues at hand than, well, what's my portfolio sitting at right now. So I'm going to keep saying it, and it's just reminder. When in doubt, zoom it out. So I wanted to put on this tweet by Chris just a couple days ago. He said, last year, nobody wanted boring dividend stocks. They bought growth stocks instead. Now they are booming. Now growth stocks are down and crypto is the hot thing to buy. You have to go against the grain. Buy what people don't want when they don't want it until they realize they do. If we look at a simple, dividend stock here, Coca-Cola, right? KO is the stock ticker. We can see this massive over 30% drop in 2020, and it's almost back to recovery. Pretty much there, minus this little run up here, but you have to go against the grain, right? In 2020, when people started selling and they sold out of fear, you have to find that as an opportunity. So I'm going to say that again. When people run and sell out of fear, you have to view that as an opportunity. some of the three, or excuse me, the two greatest returns in the market ever, like historical greatest returns in certain periods, came from right after crashes. So it's not, buying in a bull market. The greatest returns come from buying in crashes, and riding those waves back up to where they were prior to the crash. So the greatest returns, again, don't come from, buying, when the stock's at, say a 5 years into a bull market. The greatest returns come from buying when everyone else is running, right? 2020 was a perfect example. Everyone ran out of fear or whatever it may be. But the people that are sitting pretty today are people that did not run. They actually, held what they had and they bought more. So like Chris said, you have to go against the grain, because majority of people go with the grain, and that's where they fail, is because they go with the grain. They sell whenever it's, they sell low and they buy high out of fear, or whatever the case is. You have to go against the grain. And, personally, I buy every single week into my holdings. Doesn't matter the price, but when there is a dip, or last year 2020 when there was a crash, I did not sell. I held and I bought more. And I'm not saying that to brag. I'm saying that I practice what I preach. What I teach, I want everyone else to know that I do that as well. And, I'm learning from the best, Chris, and otherwise, and I'm learning from other mentors. And you're going to laugh when I say this, but, reading books is a massive way to learn from successful people. So, Benjamin Graham, the intelligent investor, reading things from Warren Buffett. You obviously can't get directly taught from them, but you can get indirectly taught from them, and learn from what successful people have done. So just to double down on that, you have to go against the grain. So I just want to show you the idea of when in doubt, zoom it out. So if we just look at it's a large company, but just an example of when in doubt, zoom it out. So this is Microsoft. MSFT is the stock ticker. If we look on the left graph here is the last 5 days of this stock. And we can see in the last 5 days, it's down over 1%. This is, again, this is the last 5 day stock graph. It's down 1.12%. So that, someone bought in last week and now they're like, oh no, I've lost 1% or over 1% of my portfolio. I'm scared, I'm fearful. But if we zoom it out, right, when in doubt, you're doubting your holding, you're doubting your buy. When you zoom it out, Microsoft is up 13% on the year. And if we zoom it out even more, this isn't the picture. This is just a piece of information. It's up 382% in the last 5 years. But this graph is year to date. So 13.11% year to date. So I know we can't go back in time and, buy at the beginning of the year, but this idea is if you just bought in today, or you just bought in this week, or, you're new to the market, you're only in for a couple months, there's a lot of volatility in the market in the short term, right? It's guaranteed. It's normal, right? That's the way it goes. There's supply, demand, the buys, the sells, pushes stock price up and down, news, reports of earnings, or whatever the case is. There's reasons for the short term of volatility of the market, but it's up to you to zoom it out if you're ever in doubt. And I want to throw this one here too, because, I've been talking a lot about stocks, but it also works with funds as well. If you follow me on social media, I'm a huge, massive fan of QQQJ. I actually bought some today because I saw a great opportunity to lower my average cost down. But if we look in the last 5 days, this fund, this ETF, is down over 3%, right? 3.37% in the last 5 days. And to be completely honest, I've been in this this fund since end of December, and I'm actually down overall. So I haven't even, not that I would sell, but I'm not even in the green yet overall in this holding in particular. But I know that's the short term. It's only been, 6 months, 5, 6, 7 months since I've held this holding, this fund. But the short term, the market is volatile. And it doesn't matter, there are, defensive stocks like Walmart, but that doesn't mean that it's not volatile also in the short term. Every single stock, every single fund is volatile in the short term. But as you zoom it out, right, this is year to date. And this graph isn't really pretty, but it's showing you that even just year to date, it's up 2.6%. And these graphs all the graphs today on the presentation were taken right before this because I wanted to get the most up-to-date information. even year to date, right? This isn't even, well, this fund it actually is less than a year old anyways, but even just, year to date. So a few, like 4 or 5 months before or zoomed out, we're up 2.6% in this fund. So again, it's the idea of when you're ever in doubt of your holdings, if you're ever in doubt of your stocks or your funds, when you're investing into good companies that you believe in for the long term and you plan to hold for the long term, zoom it out. When in doubt, zoom it out. So what can we take away from this? What can we take away from this? This little lesson. It's not going to be super long, but it's super straight to the point. If you're ever in doubt, zoom it out. Number one thing is to expect short-term volatility in the stock market. Especially if you're a new investor and your portfolio is new, you might be down overall. You might have, quote unquote, lost money. You'll never, you don't actually lose that money until you sell. So just keep that in mind. But expect that short-term volatility in the market. It's normal. It's the way the market is. It's the supply, the demand. Like I said, the up down of the graphs, day-to-day basis. It's the way that investing goes, and that's why investing for some people that don't know is scary because they're fearful of losing that money. But as you hold longer and longer, and you believe, and you hold longer and longer into companies and stocks that you believe, that volatility gets smaller and smaller. The next thing is that the more risky the stock, the more volatility you should expect. So there's this thing called the beta. And what that is it's a way to kind of gauge volatility with certain stocks. So if we look here, there's two pictures. The first one on the left is Trade Desk, and they have a beta of 2.46. Apple is the stock on the right, and they have a beta of 1.20. Essentially, what this means is that imagine like the overall market, right? Let's just say VTSAX, which is the entire U.S. market. That beta is 1, right? So that's 1.0. So anything over 1 means when the market goes down by, let's say, 1 point, Apple would go down 1.20. Now, not always. It's just a hypothetical mathematical equation to fill this out. And then, for example, I didn't change the stock ticker there. I'm sorry. It's not CRWD. It's TTD. My apologies there on the visual. But they have a beta of 2.46. So if the market goes down 1 point, the Trade Desk will go down hypothetically 2.46. So it's almost one double, a little over double the volatility of the market as a whole. Now, if a stock is under 1, that means it is less volatile than the market. But again, this is a hypothetical. It's not always the case. So you can't like gauge your investments or your risk off of this one number or this one piece of information. And also number 2 is, again, don't just say, oh, I bought this stock because the beta is 0.8 and I wanted to be safer. Always, take more information in. Don't just buy it based off the beta. But it's something good to look at in terms of just volatility and risk, as a way to just kind of gauge where you sit and how that and what to expect if you buy into that stock. So the final takeaway is this: if you believe in the stock or the fund long term, stop fearing the dips, right? The dips are normal. They are a part of the market. The market is cyclical. It goes up, it goes down on the daily, on the weekly, on the monthly, and sometimes even the yearly, it goes up and down. And we have to be able to get out of the emotional side of investing and quit fearing the dips, right? Quit fearing the dips, quit fearing the crashes, especially where you're investing in that stock that you believe in long term, right? I know that if you're trading, you're not as tied to a stock as if you are, holding it long term. So that is a different piece of information. But this is solely about long term investing. If you believe in it long term, don't fear the dips. See it as an opportunity. And then the second takeaway is fluctuations in the short term market are normal, right? And short term means even a year plus, but usually months or weeks or sometimes days, they are normal, right? They are a part of the market. That's just the way the market is. That's why the market to some people gets a bad rap, because it's like, oh, it's risky. Well, it is risky, but if you as you zoom out, right, as you zoom out your time horizon, you zoom out your portfolio holding, it becomes less and less risky, because you're giving time for your portfolio to those stocks to appreciate, as you believe in them long term. So the final thing here is always, like I said, I will say, like the title of this presentation: when in doubt, zoom it out. When in doubt, zoom it out. If you're ever doubtful, you're ever, nervous about your holdings, zoom it out. Zoom it out, and say, okay, yeah, I've only been in this stock or fund for the last, 3 months or the last 2 months or the last one day. Like, I understand it's going to be volatile. I'm going to zoom it out. I'm going to zoom it out. And when you do that, you take away that emotion, you take away that fear, and you allow your money to just kind of work for itself into that portfolio. And another piece of information: if you are ever fearful, send me a message. Here's my social media. Send me a message, and I will, talk you off a ledge in the sense of selling your holdings that you want to hold long term. But I'm going to open it up here for questions. The last thing is, you can follow me and find me on social media or within the Well Squad. Is my name is also Decade Investor in there. But that's my Twitter at Decade Investor. That's my Instagram at Decade Investor. And then I just started, well, I didn't just start it, but I recently got back into doing YouTube. And I've been, in the last couple of videos, just showing up my portfolios, ripping back and just showing you what I'm holding. I wanted to go more in depth on my portfolio and my investing strategy, and just, continue my reach out there on YouTube. So you can find me on all three of those platforms, all Decade Investor. Any other variation of the name is a fraud, is a scam. Is going to try to take your money, and I will never do that. So if you get a weird message from a, not at Decade Investor, then that's not me, and you will lose money. So send me those if you find those, because I've been seeing a lot of those lately, and it's frustrating because people fall for that trap and get their money scammed. So at Decade Investor, no other variation. I only have one account, at Decade Investor on Instagram, only one account, and Decade Investor on YouTube. You can check me out there. But I'm gonna stop the screen recording here and open it up for questions. So the best thing to do is just raise your hand, and I'll call on you because too many people shouting kind of gets confusing. So just raise your hand if you have a question. So thank you all for joining.